want to give you an example of how to just perform some of the solutions to what you may see on an exam. Here we have um, a problem where they list the accounts, equipment $3,300, cash $2,400, and so forth. And with this information, we're asked to prepare an income statement. Now, again, if you have followed the slides, if you've read the textbook, you know that some accounts belong on an income statement, others do not. So here, what you have to do is determine which of these accounts belong on an income statement, and then those that do not. So, does equipment belong on an income statement? Does cash? What about rent expense, accounts receivable, and so forth? So I want you to right now think about which of these belong on an income statement. And there are 1, 2, 3, 4 that do. 4 of them. Hopefully you have picked out the 4 that do. Don't forget, an income statement is revenue minus expenses, right? So let's go down here, and there we are. And this is how I want you to construct an income statement. The revenue, as you see, is 16.3. You have your wages, expense, rent expense, utility expense. And expense is a dead giveaway, the word expense. And the word revenue. Now, it doesn't always contain the word expense, but for the most part it would, and there you are. Now notice you have, you set your revenue to the side, and you list the expenses, and then you total the expenses and subtract them from the revenue, and you get net income. Now again, you can have a net loss. Students often, most businesses will incur a loss from time to time, or at least sometime in its history. So on an exam, if you may not always be net income. It could be net loss. I mean, if the expenses were greater than 16,300, there would be a net loss. Okay. Okay, so that's that problem. Now let's go to the next one. Let's see what we have here. Okay. Again, here we have accounts, some information. It's a consulting firm, and the owner contributed $85,360. That's the investment the owner made. And at the end of the month, this is what you have here. So the business began on October 3, and on October 31, we end up with this information here. This is what has happened during that 28-day period, that 4-week period. So look at what's happening. We got, and notice the order. This order is very important, and you'll learn it later on. When you're listing the accounts on a business, you tend to list them in the order of the balance sheet first, which are the accounts from cash down to owner's investment. And then starting on the right-hand side, the income statement starts with revenue down to expenses. Now, cash withdrawal belongs only on pretty much only one statement. That's why I skipped over it, and you'll see where it belongs. But this order is very important. You won't have to do it now, but you have to know this order before the semester ends. So now, with this information, what do they want us to do? Prepare an income statement. just like before. Now, which of these accounts? Now, you can look here. Look there. You see revenue and you see expenses. They made it easy for you. Okay? So here's the income statement. You list the revenue, and then you list the expenses, add them up, and subtract one from the other. So the net income is $540. Keep that in mind. $540 net income. Why? Because on the next one, they wanted to prepare an owner's equity statement. And in order to prepare an owner's equity statement, like I said before on the slides, you need the net income information as well as some other information. But you must develop or construct a net income statement first, an income statement first to arrive at net income, because you're going to use net income as part of developing owner's equity statement. So, with this information up here, we need to develop an owner's equity statement. Look at this. And there are basically three things you need. You've already developed one of them, that's the net income. But you also need two other bits of information from this list. Do you know what it is? Do you know what they are? Okay, let's scroll down and see the answer, folks. Aha. We began October 1, 0, because the business didn't start till October 3. Anyway, the owner invested $85,300, which is this up here. See that up here, right there? All right. And then what we do is we add the net income, which we derive from the income statement here. And that gave us $85,900. Then we subtract the withdrawal. Where did the withdrawal come from? It's up here, folks. It's right here. $33,900, or $33,990 rather, excuse me. So we have a new capital amount of $82,510. You add income, you subtract withdrawal. And by the way, if it had been a net loss, you will subtract it. You will subtract a net loss. Okay. And now they want to prepare a balance sheet. Well, we're going to use this figure here, this new figure, $82,510, to develop part of developing the balance sheet. And notice this. These all came from above, right? All of these numbers came from above, right here. That's where they came from. But notice, you add up all your assets. You have to know what an asset is. You have to know what liabilities are. And this is the new capital we calculated. It's not the original one, it's the new one, because it includes deductions for withdrawal and the addition of net income. You see how they balance? Total assets equals total liabilities plus owner's equity. That is the accounting equation. They must balance. If you do not balance, you've made a mistake. You list the assets and add them up. You have to know what's an asset. Okay? And it's true, if you put liabilities over here under assets, you're still going to balance. Oh, no, you won't. I'm sorry. I meant to say, if you had them over here, you're going to be out of balance. So, folks, you have to be able to know what goes where on the balance sheet. Look at these accounts. Okay, a payable is a liability. You can have notes payable, salaries payable, interest payable. And then, again, it may not have the word payable. It could be a loan. Okay, a loan is a debt. It's a liability. You have other kinds of assets. You could have building. You could have We got equipment supplies here. You could have prepaid items like prepaid, which we'll get to later. So keep all of this in mind, folks. Okay. And now what I want to do is also go over, that was what that was that quiz? I think, no, I think we're going to go here. No, let's go back. I think I want to go with homework, I think it was. Yeah. Let's do a bit of a preview here. Only certain problems I want to go over. Oh, well, okay, they gave you the answer here. My screen shows the answers, but you notice here, assets got to equal liabilities plus owner's equity. The ones in yellow were missing. Okay? But anyway, let's see what we got here. And this is kind of what we did one by one on the slides. For instance, invested $18,800 in the company. Well, you see that? Cash went up and so does capital. See that? Right here and there. The owner purchased supplies for cash. So cash is going to go down and supply is going to go up, right? And that's what you see right there. Cash went down, but supplies went up, and both are assets. Okay? So it doesn't affect the equity side at all, or the liability side. The owner invested $11,900 of equipment. So what happened? Equipment went up, and so does the investment part. Look at this. Where's that 11,900? See that? 11,900. Equipment went up, and so did the investment went up. Okay? So there's a total investment of $30,000. The cash he invested plus the equipment. And then purchase $390 of supplies on credit. So supplies go up by $390, and so does the debt, $390. And purchase land for cash. Land went up and cash went down. Okay? Okay. Let's take another look here. Let's see, what is this? Okay, another example, filling in the blanks. Which again is straightforward math. Now again, we have information like on the previous example I gave you. And look how they're listed. You see how the balance sheet accounts are listed first on the left-hand side, and then you have withdrawal, which is a separate item, and then the revenue, the income statement accounts there. So you should know how to do this. Okay? We just did an example of that. Prepare an income statement. Well, we know we're going to go from revenue and then the expenses, right? And there you go. The revenue is $13,500. Those are the expenses. So we have net income of $24,10. We're going to take that $24,10. What we're going to do with it, folks? We're going to include it in our statement of owner's equity. We start out with this investment. That's the net income we just calculated. And then the withdrawal of $1,570. Where'd that come from? Go back to the top. You see it right here. Okay. Now don't forget, the only place that withdrawal occurs is on the owner's equity statement. Withdrawals do not belong on the balance sheet, and withdrawals do not belong on the income statement. They only belong on the owner's equity statement. And also notice this. The income statement and owner's equity cover a period of time. You have to identify what period of time you're talking about. The balance sheet does not cover a period of time. It is a moment in time. And here's our balance sheet. Okay. Again, we added this new capital. Everything else is drawn from up above. We just copied them, brought them down. But this is the new one here. Okay. All right, let's see what else we have here. That may be fun. Okay, it's the same example before. And this is a nice problem here. Okay. At the beginning of the year, assets were $268,000 and an equity of $201,000. Think about that. Don't forget, assets equals liabilities plus owner's equity. If the assets were $268,000 and the equity is $201,000, what must have been the liability at that point in time? $67,000. So during the year, assets increased by $80,000 and liabilities increased by $45,000. What is the equity at the end of the year? Just think about that. I want you to take out a piece of paper or something. We know that we started with $268,000. We know that the equity is $201,000, so you had to have $67,000 in liabilities. Now, during the year, assets went up $80,000. Liabilities went up by $45,000. So that would be 0, 0, 0, 12, 1, 1. And I'm just doing it here by hand, 14, 348. So what's the equity? I got $236,000, and there you go, $236,000. Okay? See that 67,000 there? That's what it had to be. Let's see. Okay. And it shows you here the detail right here. Look at this detail that shows you. Okay? How they came up with it. Oh, okay, another problem. Office store has assets of $235,000 and liabilities of $198,000. So what's your equity? It's the difference between the two, right? It should be about $37,000. There you go. Here's another example. At the beginning of the year, Quaker Company liabilities equals $70,000. Assets increased by $60,000. And at year-end, assets equal $190,000. Liabilities decreased by $19,000. What is the beginning and ending amounts of equity? Okay. Again, beginning of the year, they had $70,000 in liabilities. All right. At the end of the year, the assets were $60,000. They went up by at the end of the year, the assets were $190,000 and had increased by 60. So it started out with 130. So 130 assets, so you had about 60,000 equity then, right? And then during the year, as liabilities decreased, what was the beginning and ending? 60,000, like I said at the beginning, and you can figure out the ending. Just look at this, folks. You got to understand how assets equals liabilities plus owner's equity. Once you keep that in mind, you can determine the ending balance or the beginning balance of equity or liabilities if you give enough information. But keep that equation in mind. That's called the accounting equation, and you must keep it in mind. In any event, I'm going to end this session, and I hope that you found this useful as you carry on. So now this is I must rather inelegantly get out of this session here and end it. I don't know any other way to do it.